Hey everybody, Vince Dowd here, coming to you live from Fort Lauderdale, Florida, where it's 8 p.m. and we are starting the Money Talk. And if you're coming on, please just go ahead and mute yourself. Make sure you're on mute. And if you want to leave your video going, that's fine as well. We don't have a long time on here tonight, so I want to get right to the meat. And I will open it up at the end for a Q&A if you have any questions. But we have about 30 minutes of time to discuss strategies and some ideas about financial literacy, and then I'll open it up to questions. So I don't want to waste any time, but if you are coming on, make sure you do let me know. Maybe use the little icon and click. I think you can raise your hand or give me a little bit of a signal out there somewhere. Or if your video comes on, just wave at me and I'll see you come on. So part of the Authentic Elevation room, I want to give you tremendous value. And so in doing so, what that means is I want to share with you what I've learned over my life. So if you don't know who I am, I started this brand, Authentic Elevation, to help people elevate and become more authentic, to live their authentic lives. And that really starts with not censoring yourself and also elevating our emotions and our frequencies so that we're operating at higher levels. Now, that's really important that we do that so we actually have more impact in the world. So I think that's very important that we do that. Now, tonight I'm going to discuss financial literacy because it seems like that's what people are really looking to gain, is more financial literacy. So what I'm going to do is I'm going to share with you tonight a couple key areas that might help you. Again, since we only have 30 minutes and about 10 minutes for a Q&A, I want to get right into it, okay? So I will stop along the way and ask if there's any questions to see if you're with me or not. Bear with me, I have some people tapping in here real quick. Let me just see what the message is. Okay, great, we're good. So let me just tell you a little bit about me. Well, first, let me just talk about what we're going to do tonight. I help people to move from money stress to financial power. That's what we're going to do tonight, is moving from money stress to financial power in 2020, which is a great year to do that with such a great number, 2020. So if you're coming on, definitely, you can chat to me, by the way. Just go to your chat feature. If you have any questions, I should see those pop up. Now, I'm going to be transferring between 2 or 3 different devices here. It's my first time doing this, so bear with me if there's a little bit of a hiccup here and there. But I'm using my iPad to draw with so that I can draw out some things for you, as well as this monitor so that you can see the PowerPoint or the keynote presentation. Now, what I do is I help success-oriented individuals, people who feel stuck, to achieve their inner alignment so that they can live an epic life full of connection, not only with themselves, but with other people. Also live a life of purpose, fulfillment, and flow. And I know that this is really critical if you have that on the inside. All of our life, everything that we do out here starts on the inside. It's an inside job. So that's really what we're going to get into tonight. Again, tonight I'm going to get a little bit financial with you because I think it's important in today's society that people have financial literacy. You know, Zach and I were talking today, and I found that 3 out of 4 people in America are not financially literate. That's pretty scary. The increasing lack of financial literacy in our country is causing major financial damage to households across America. And I know this is happening worldwide, but I think my time in Europe and Asia, I think people are a little bit more structured over there, a little bit more together because there's not so much debt carried in most countries like Americans. So tonight what we're going to talk about is money and currency. Now, what is the difference? We'll talk about that. We're going to talk about debt, good and bad debt, because there are 2 types of debt. We're going to talk about investing a little bit. I'm going to share a couple strategies with you that can really do well for you in your financial portfolio. So let's dive right into it. First of all, let's talk about really the problems right now that people are facing in this country, but also worldwide financially. The first thing is people feel very confused. When it comes to money, when it comes to financial literacy, People sometimes are just like, I don't get it. You know, I remember in school when I was a kid, uh, we didn't really study a lot around money. And I came from a family that didn't have any money. So when you go out to the world and you start making these greenbacks, these dollars, or whatever currency you are earning, it is confusing if you don't know what to do with it and you've never had the role models in your life. So confusion is one of the problems people face. Another one is stressed out. People are stressed out today more than ever. As we have more inflation and we have more demands on our time, more distractions from everything from social media to television to the news to our demands at home or the demands at your career, people are living in chronic stress. And that does not help you when you're operating in fight or flight. The third area is people feel like they're running out of time. So you add to that the stress, confusion, and having no time. What happens is people just end up just giving up, and it will impact them really in their pocketbook. So let's just dive in to helping you resolve maybe some of these problems. First of all, these problems will lead people to poor choices, especially if you have a lot of stress in your life. People make poor choices. Also, a lot of times people make very high risk investments, high risk choices, and that will lead to financial failure. I myself have done that in the past. I've taken very high risk scenarios and it's lost me millions of dollars. I want to save you from that pain because you don't need to reinvent the wheel. You can learn from people who've already gone down the road with that wheel, even if it was a flat tire at some point. So the key opportunity here for all of us is, first of all, to own your power, not only internally as a abundant human being from the inside out, but also externally by having the proper financial literacy to make proper choices in today's economy. Number two is to live in flow. When you're living in flow, your life just seems to move with the river, with the current, if you will, and things become easier when you live in flow. And then number three is to buy back your time. If a problem is we're running out of time, then a key thing that we can do with the proper knowledge, the proper financial literacy, is to buy back our time. In fact, write this down if you don't know it. Smart people trade time for money. Smart people trade time for money. Now, if you think about it, there's a mantra that says, time is money. Have you ever heard that before? In fact, if you've heard that before, type yes right now. Type yes that you've heard time is money. And by the way, where did you Did you hear from your boss or maybe somebody in your life? If I asked you the difference between time and money, which I do in my seminars, what would be the difference between time and money? You can type it in if you would like to do that. Time and money, what is the difference between the two? Obviously, time is finite and money is infinite. However, most people spend their entire lives holding on tight to money. They're chasing money, spending all their time trying to get more money, and they waste their time. They watch television. They use their non-productive time non-productively. And therefore, the big difference is finite versus infinite. So what we want to do when we learn to make more money is we can buy back our life and we can use our life in purpose to impact and to serve others. And that is the ultimate goal for me at Authentic Elevation, is to impact community, impact society so that we can really make a difference on the planet. Money is really just a concept. It's a measuring stick for how many people you serve. The more people you serve, the more money you make. Make sense? And then when you get this right, you can live an epic life, a life full of purpose and impact. And I think that's what most of you want to do. In fact, what is it that you want to do? Type it in right now if you would not mind sharing. What is your number one purpose in life? If you had really good money coming in and you were stable financially, maybe you had financial freedom, what is it that you would do with your life long term that would satisfy you, that would make you really feel fulfilled? Type that in right now. If you don't mind sharing it, I'd like to see what you're saying here. And obviously my mouse isn't working. Oh, there's my mouse. let me come to it. Bear with me. I'm going to come out of this real quick and look at what you said here. Bear with me. I'm a new Zoom user, so let me find where the chat went. Where's my Zoom? There it is. Okay. I cannot find my chat. Interesting. It's funny how when you do these things on practice, you never experience the same issues that you do when you do it live. Isn't that wonderful? Okay, so here's my chat or my Zoom box. There's chat right there. And I don't see the chats appearing now. I can hear somebody though. Who's on? I can hear somebody. I hear nobody. Okay. Okay, well, listen, I'm not going to go. I'll just trust it's there. When it's over, I'll come back and look at it. Let me just keep going on the program so we can get right into it. So when you have this life and you're making these choices, why do you want this? That's the real question. Why do you want to have your financial life in order so it's in alignment with your internal abundance, and your external abundance is just a reflection of what you do internally? You know, for me, it used to be I wanted to have a lot of nice things and I wanted nice cars and houses. And once you get that, it's really, in my opinion anyway, not that fulfilling. What's really fulfilling is being able to impact the world and to travel. I love to travel. You know, we're heading to Hawaii on Saturday. We're heading throughout Europe for 3 weeks coming up in a couple months. I love to travel, see the world, get perspective. But whatever your reason is, that's your reason. And that should really motivate you to move forward, to learn key things and to align your strategies. So we're going to talk about 4 key principles tonight that I want to share with you. And in doing this, hopefully you'll gain some great value out of this. The first thing I want to talk about is money and currency. Now, there is a difference, by the way. In fact, if you know the difference, type it in. What is money versus currency? If you know that in the chat box, I don't know where the chat box is, but type it in if you would. And I can check on that here when this is over here. I don't see the chat. Oh, there's a chat right there. Travel, somebody said. Wonderful. So on my iPad, I can see the chat, so I can see you now if you're typing this in, at least on the chat box on my iPad. So I'll explain to you the difference. Money is constitutional. In the US, money is considered real value. So that would be something like gold and silver. So money has always been intrinsically valued, something that we can exchange, but it also takes work to create money. So gold and silver, it takes energy and manpower to pull it out of the earth. Currency, however, is fiat. It's basically an illusion, paper. So paper has no real intrinsic value. It's technically an IOU. It's an IOU saying that I will pay you at some point in the future with real money, which would be something of intrinsic value like gold. And this has all changed over the years. So if you're not familiar with how this all came to being, I want to share with you a little bit about how this happened. And I'm going to switch over to my iPad here so I can draw it out for you. And to do that, I got to stop sharing here. Okay. And then I'm going to share on my iPad here. Bear with me. Okie dokie. And you should be seeing a note in front of you. If you do see that, let me know. So just so you know, the way this works is money is really the real value that we want. But what we have today in America and around the world is currency. Currency is fiat, which means it's not real, and usually they collapse within 40 years. So let me show you what I mean by that. Money itself was exchanged for currency. So we had back, I'm going to do this here on the pad, back in 1913. Does anybody know what happened in 1913? Anybody know? we had the Federal Reserve Act was passed in America. Now, if you're not familiar with the Federal Reserve is the entity that basically runs the money in the United States. And since the United States is a reserve currency, we are the #1 currency in the world. Basically, all the other currencies around the world work off of our US dollar. Now, this is very powerful because it gives us tremendous control in the monetary system. Now, if you don't know this, the Federal Reserve, which my lines aren't even connected very well here, the Federal Reserve is not federal at all. The Federal Reserve is as federal as Federal Express, which means it's a private company. The Federal Reserve is a bunch of private bankers who back in 1910 had a meeting at closed door meeting. They went in secrecy. People like the Warburgs, very wealthy individuals, met on the island called Jekyll Island. And Jekyll Island is basically where the connections were created and the laws were set in place to create the Federal Reserve Act of 1913. And the ultimate goal of these wealthy, powerful elite was to control the money supply. And they knew that they could take over the money supply. They basically steal the wealth from the masses over time by a series of inflation and deflationary practices. So today what they've done is they've created an eroding of what we call money, which is really currency, and they've stolen the wealth of the people. Now, I'm going to encourage you to research this, and I'll give you all the resources you need if it intrigues you. But just trust me, I've done the work on this. 1913 changed everything. The Federal Reserve created a system to compete and to take control of the banking. Thomas Jefferson said, if we ever let the central bank run our country and run our money supply, your children, our children, will end up in the streets poor and broke. And that's because he knew the powers of the central banking system if we allowed them to control the money system. Our Constitution never was meant for any entity other than Congress to print money. But this happened in 1913, and therefore we started this, what we call a Ponzi scheme. Now, if you're familiar with a Ponzi scheme, what it is we have those at the top make all the money, and those at the bottom basically are paying into the system. So the reason that the US has a Ponzi scheme through the Federal Reserve is because the only way that we can create more money is to create more debt. So debt equals money. Now, let me ask you a question. Have you ever thought why there's such a push on every level for you to get more credit cards, to get more bank loans, to get yourself deeper and deeper into debt? Why do the credit card companies go to college campuses to kids who are financially illiterate and push them to get credit cards? Because it creates more debt. Now, the more debt in our society creates more money. And the more money creates more inflation because we have more dollars chasing less goods. And so we have this problem, and it's going to collapse on itself. So I want you to know that so that you can really start to look at this from the eyes of an investor, an eyes of somebody that looks at wealth not just externally, but inside yourself, so you're prepared. All right? So that's the Federal Reserve. Now, by the way, what they created is the fractional reserve banking system. If you've heard of that fractional reserve banking system, type in yes right now and let me know that you've heard of it. If you haven't, type in no. Because as I've traveled for like 25 years teaching financial literacy, most people have never even heard this before. They didn't know the Federal Reserve was not a government institution. They thought it was governmental because it says federal. Well, so does Federal Express, and we know that's a private company. So if you have not heard of this, I'm going to hopefully enlighten you on some things, and that's wonderful. Well, thank you. Said no. Now, here's the key. The Federal Reserve created a system of banking called fractional reserve banking, where here's what can happen. I'm going to show you this because it's very powerful. You can go out there and you can go out and let's say you have $100. As a depositor, you take your $100 that you've earned, right, and you put it in a bank. Okay, that's a bank. My stylus is not the greatest, but you get the point. So there's the bank. Now, when you put the $100 in the bank, most people believe their $100 is sitting there in the vault waiting for them. And that's the way it used to be, but it's not like that anymore, because once they got rid of our gold standard that backed up these IOUs called dollars, where we used to have $1 equaled $1 of gold in value as a receipt, if you will, today it's not like that. Today, the fractional reserve banking system says if you go ahead and put $100 of your money into the bank, by the way, when you do that, you are not depositing, you are loaning the bank your money. Now, that's important to understand, which means you're giving them your money and they can use it as they see fit. They can go invest in the stock market and currencies, they can loan it out, they can do what they want. You signed that into agreement when you signed your agreements to open a bank account. Most people don't read the fine print. So now that's not even your money. But here's what they do. They take this $100 and they reloan it out to other people, and they do it on a fractional reserve system, which means for every $100 the bank takes in, they get a loan out $90 to somebody else. They have to keep, let's say in this example, 10%. Every bank is a little bit different, but about 10% reserves. So they know that there's 10% of however much money's out there, they have 10% in the bank itself. In fact, have you ever gone to the bank and tried to take out money and they say, we don't have enough money to do that, you need to call and we need 3 or 4 days? If you've ever had that happen, let me know. Type in yes on that. I've had that happen, and you have to wait because they don't have the money available. Try to take out 4,000 or 5,000 sometimes, and they're going, we have to get some notice. That should scare you right there. So what happens now is this $90 is loaned out to this gentleman. We'll call him Joe. Now, Joe, he'll go out, and maybe he puts that $90 in another bank. That bank then can take 90% of that $90 and loan that out. So what's happening now is we're actually getting more money into circulation based on these little amounts of money. That's called fractional reserve. And that's pretty scary, because if there ever is a run on the bank like there was multiple times in our history, you're going to go to the bank and find that your money's not there. And that's a very critical thing to understand. The bank is not a good place to keep your money. And I've said this time and time again, it is one of the worst places to keep your money. Obviously, we need to use banks because we have bills to pay, and to have money in the bank to some level is kind of important. So that's the Federal Reserve fractional reserve banking system, the creation of the Fed. Any questions on that? Feel free to drop me a quick chat on that, and I'll see if I can answer it for you. But it's really important to understand this, because right now in America, 63% of Americans do not even have $500 in their bank account. This is according to Forbes magazine. That means 63% of Americans who are working Americans, over 30-year-old typically, they don't even have $500. That is the fact that we have an alarming rate of financial illiteracy. On top of that, 42% of Americans are living paycheck to paycheck, which means they don't, if they lost their job, they're a matter of weeks away before they lose everything, their car, their home, their belongings. They have a problem, okay? And I see this all over the world, but really America is much deeper debtor nation than other nations. So I want you to think of money being energy. All money is an illusion. It's paper, but it chases you or it runs from you based on your energetics. Okay, so money's like energy, and it's either going to come towards you because it desires you, or it's going to run away from you because you're chasing it. And that's really what money is. I remember when I was younger and I used to chase money. I wanted money, but everything I did was like kind of gross. If you ever have dated before, and maybe you've liked somebody too much and you start to chase them, you get a little bit needy. What happens? Do they usually find you very attractive and they want to be with you more? Or do they run from you? Which one is it? Type it in right now. I doubt if they run towards you, they probably run away from you. In fact, it gets really gross and needy. Well, money is like energy. It does the same thing. And at the end of the day, they run from you. Yes, absolutely. And so at the end of the day, what we want to do is we want to create an environment where money is chasing us and we're not chasing money. And that starts on the inside first, because when you have your imprint right on the inside and you know who you are and you know how money works and that energy, then the external world is a reflection of your money. So that's an example of what's going on in the financial world today on money. I want to take you a little bit deeper now. I'm going to switch back over real quick here to the slides. Let me go back here. And let me stop sharing. Come back over here. And let me share this screen. Okay. You should be able to see my keynote up. So we talked about money. Let's talk about assets and liabilities. Most people, again, do not even have the basics down on assets and liabilities on their financial literacy. In fact, I jotted down a couple notes just to show you what I'm talking about here. Let's see where to go. Okay, so a lot of people don't have a habit of giving. They don't have a habit of paying themselves first. One of the first books I read early on financial literacy is called The Richest Man in Babylon. And in this book, it was critical that you pay yourself first. Every human being, what they tend to do when they're making money is they pay the bill collector first. It is really important that you pay yourself first. That's how you get wealthy. You should always take 10% of whatever you earn and pay yourself first. Nobody touches it. And that's number one. Number two should be giving 10%, because when you give, you create the conduit for flow. If you think about currency as like a current, it moves, it has to move. So if you're giving money, you automatically come from this internal place of saying, I am wealthy, the universe provides for me, and my value provides for me, so I can give because there's always money coming to me. Because money is not out there, it is in here. So the two things I want you to know right away is, please, make sure you're paying yourself first, at least 10%, and make sure you're giving wherever you want to give, but give because you come from a place of wealth. Now, assets and liabilities, a lot of people tend to not understand the difference on these. So let me ask this question. If you think about, you just went out and bought a new car, whether you bought it cash or whether you're financing it, tell me, is that an asset or a liability? Type it in now if you want to answer that. It'd be wonderful. Is a car an asset or a liability? Now, some of you I know cannot type it in because you're traveling and so forth, but let's just see here. I'll look at it on this one actually, because this will be easier for me. Okay, chat. Liability, absolutely. Okay, so good. If you're passing that test, that's wonderful. A liability, and the reason it's a liability is because it takes money out of your pocket. Anything that you purchase that takes money out of our pockets is a liability. However, if you purchase something that puts money in your pocket, it's an asset. So the next question, is a house that you live in an asset or a liability? Type it in now. Is an asset or a liability? A house that you purchased to live in. A lot of people think it is an asset because they believe that the home goes up in value, which is the capital gain. That is true. But you got to remember, it's not an asset because it's taking money out of your pocket. If you look at the bank's books, the bank has it listed in their asset column. For you, it's a liability. Now, that same house, if you actually use that house as a rental property, that would be considered an asset. Because if you have that house and it's being rented and you get cash flow every month after the bills are paid and the mortgage is paid, and you get an extra $50 a month, you have a cash flow of $50 a month, that house becomes an asset. So that's why it's important, instead of having a big house, spending a lot of money on a liability, that you get a smaller house and maybe use the extra money to buy a rental property that you cash flow. And that's how you build wealth. All right. Another example would be this. the way people think around assets and liabilities. We want to limit our liabilities. We want to try to get out of debt. That's really critical. Get out of debt, limit our liabilities, spend less money on things, or vacations or big screen TVs or watches, and use that money properly into assets so we can grow our wealth. Now, a lot of people think, well, I can't afford to do that. And right away, their thinking is all about, I can't afford. So they're shutting down their resources before they even start. What Robert Kiyosaki, who I used to work with in the UK with the Rich Dad Poor Dad organization, will tell you is you got to think differently. The only difference between the wealthy and the very poor people is the way they think. Anybody in America, for example, can become very wealthy if they change their thinking and their actions. So instead of thinking, I can't afford it, maybe if we switch that to around to how can I afford it, we would have a big difference, right? How can I afford it? So start asking the questions, how do I do it? And you'll start getting creative and you won't shut down the resources. Now, the next thing I want to talk about after assets and liabilities, we're going to talk about debt. But before I do that, let me see if there's any questions. If you have any questions, please shoot me a question now on chat. Feel free to engage, guys. If you're out there and you have any questions, I want to make sure that we address them for you. Okay, I don't see any questions coming in, so I'm going to move on. So far, though, let me know what's been the most important thing you've learned right now. Go ahead and type it in. So far, what's the most important takeaway you've gotten out of the first 15 minutes or so of this presentation? Could be anything around what we talked about money, could be about assets, liabilities. Let me know what you think it is. The asset and liability thinking, wonderful, thank you. Okay, so let's get into debt, good debt or bad debt. Now, when I grew up in my family, I don't know about you, but debt was pretty big. We were always in debt. The good thing about my mom, though, she never got deeply in debt. We kind of lived in debt. And I remember not having money, and I had a point in my life where I was working in a corporate job, a Fortune 50 company. I was making $30,000 a year, probably started more like about 20,000. And I started getting into debt because I got my first credit cards in my early 20s. And I remember I thought, oh, they're giving me free money. So I went out and started buying things on my credit cards, like beer, pizzas, clothes. And what happened is I started to build debt. Then I started a couple of side businesses and I got deeper into debt. So I put all this on my credit card and I didn't have a lot of income from my career. So my debt built up and I didn't have a lot of money. In fact, I got to a point where I was living on overdraft protection. Now, I don't know if you remember this, back the banks used to actually go out and they would allow you to take overdrafts. So if my balance went below zero, they gave me $5,000 to use like a loan, and I had to pay interest on that. But I got below the zero mark, and I kept trying. Every 2 weeks I get my paycheck. I was just trying to get to zero, to break even, and I thought that would be good. So I was living in debt. I had big debt on my credit cards, and that was miserable. Little did I know most of my debt was very, very bad debt because it was costing me more money and it was not putting money in my pocket. The smart thing I did, though, is I bought a house at 23 years old and I put 2 roommates in it to help me pay for the debt. And I didn't think of it as an investment. I thought of it as just a way to be able to pay in a mortgage. But here's how stupid I was and the mistake I made. At the same time I did that, I went out and bought a brand new car. I think I paid $25,000, $30,000 back in 1993 for a Nissan Altima, maroon red with gold handles, and I had it pimped up with the dark windows. And it looked nice, but now I was financially struggling. I had all this debt on my mortgage, on my car, and on my credit cards. I was miserable. And that's how I started to really realize that I was in deep debt, and that was not a good place to be. Money could be used to buy time. Yes, money can be used to buy time, absolutely. And that's the key that we want to do, is we want to minimize our expenses and our liabilities, increase our money and our assets, and then we can use the money to buy our time. So I say there's good debt and bad debt because there are 2 different types of debt. I started to filter my money into things like learning how to trade the stock market. So I paid like $3,000, $3,600 to go to this course on learning how to trade the stock market. And because of that, I learned how to make money faster using leverage. I bought a house, which cost me quite a bit of money, but I ended up making $20,000 profit on my first house in capital gains. So what I started to learn is by buying things that made me money, whether it's skills, investing in myself, or investing in things that actually will produce cash flow or growth over time, that's called good debt. But if you look at most people in America, they would rather buy a Louis Vuitton bag, a big screen TV, and computers and iPhones. They'd rather spend $1,000 on this than put $1,000 in a fund, and that's where they end up in a lot of trouble. Okay, so there's a difference between good debt and bad debt, and I think it's very important that people understand that. And implementing more good debt in your life and get rid of the bad debt. In fact, I believe people should be debt free. If you have any debt on credit cards, if you have any debt that you're carrying and you're not paying for every month, that would be called consumer debt, revolving credit, and it can be very, very bad for your financial health. So I'd encourage you to pay off your debt as quick as you can. There's a great slogan one of my mentors used to say to me, that if you owe anybody anything, you're a slave to them. So if you owe money to a bank, you're a slave to the bank because you're not totally free in America as a free sovereign individual until you're debt free. You can be free with no bars around you, but you have the bars around you of financial burden. And that's so important to get debt free. Okay, so let's talk about investing strategies. We only have a few minutes, and I hope this does not cut off. This is Zoom's only giving me 40 minutes. If it does cut off, I'm going to use the same ID, hopefully, and sign back in. If it doesn't work, then we'll do another event coming up. But I wanted to challenge this, but I'm going to keep going and see how we do. Okay, so hopefully you'll stick on here and we'll see how this goes. So let's talk about strategy of investing. If you invest in the financial markets now, let me know. Type in yes, you're investing. That means you have money in the financial markets in some way, whether it's stocks or bonds or options or currency. Let me know if you are investing. Okay, I'm getting yeses. Okay, wonderful. Good. Now, that's where I started making my money is through the financial markets, and I learned to do what we call trading the stock market. And I learned to use options, which is a leveraged instrument. And that made me a lot of money, and I was very passionate about it. I'm not going to teach tonight anything like that, but I am going to give you a couple quick strategies that you can look at and start to research that will make you a more conservative, but yet less risky approach to making money. And this can really help you to grow your wealth over time externally. So let me get into that. The first thing I wanted to talk about is, well, this is a great quote, by the way, lost time is never found. And the one thing I will say is if you start investing early, if you're younger and you start investing early, you have time on your side. So you have the compounding effect that in the beginning, it seems maybe slow. And for me, I liked it fast, so I liked trading. Looking back now, I really regret not getting involved in stocks and sticking with some of the stocks I picked, because I picked some great stocks that today are the Google, Amazon, things like this. So let me ask you a question. Here's a question for you. Would you rather have a penny doubled for 30 days? So it's going to take you 30 days, a penny, and you double it every day for 30 days. Would you rather have that, or would you rather have $1 million given to you right here, right now? Type in what you want. Type in penny for the penny or 1 million for the million. Type it in and let me know what you would do. Okay, I got yes, I got $1 million. Okay. Some of you aren't typing, but that's okay. You're going to make a decision. Now, a lot of people will say the million because, especially in today's society, people are used to get rich quick, or I should say instant rice, drive through. They're used to everything being quick. So when you give somebody the option of making $1 million right now, that's not delayed gratification, that's right now. Or waiting for 30 days, that's like too long. People would rather do that. The interesting thing is, it's the same question as if I asked you this. If you had $1 and you doubled it every day, would you rather have the dollar doubled every day for 20 days, or would you rather have $1,000,000? Same question. Let me give you the example. Most people would choose the $1,000,000. By day 10, of doubling a dollar every day for day 10, you're up to $1,000, $1,024. So right away, people are thinking, wow, I've only made 1,000. I could have had $1,000,000. Here's the point. The actual compounding value comes in the later stages of compounding. By day 20, had you doubled the dollar every day for 20 days, you have $10,000,000. If you allowed the penny to double every day for 30 days, you have $10,000,000. Okay? So that is the power of compounding. And that's why time is never found once it's lost. Let me talk about a strategy here that I've been researching that I think is a really good, safe strategy. It was put together by one of the top hedge fund managers in the world. He calls it the Holy Grail of investing. His name is Ray Dalio. He runs a fund called Bridgewater. And now Ray has an interesting story. He started his company back in 1975 in his apartment in New York. He was sitting at his apartment table and he started with just $3 million, investing it for other people. It has since grown to $150 billion under management. Here's the exciting thing. 50 billion of that has been profits for his investors. And if you look at what Ray does, he looks at risk and risk management, and he talks about his strategy. Now, Ray's strategy is really a strategy about non-correlation. Now, if you've ever looked at the stock market, typically the market will have correlation or non-correlation. So that means, maybe stocks go up and bonds go down, or maybe currencies go up and gold and silver go down. What it is really looking at what's moving based on the money flowing into or out of different asset classes. It's very hard to figure out where to put your money when you're trying to figure out where the big money's going. And oftentimes people are very wrong and they lose all their money in the stock market and they lose their money investing. So what do most people do? They turn their money and their control over to a fund manager. In fact, if you've turned your money over to a fund manager, let me know, type in yes. And I'm going to tell you right now, it sounds good because people think I'm too busy. I'm going to let them handle it. I'm going to give you a couple tips. I used to work for a fund manager, and not work for him, but I worked with him on his strategies and what he did. And what I learned was very powerful. If you don't know this, the average fund manager, in fact, 96% of fund managers do not beat the market. So they are no better than you. But the thing is, they're going to charge you fees, and those fees compound. And here's what happens. Fund managers are paid to track the market. If they match the market, they get bonuses. Imagine your end, the fund's down 20%, but the market was down 22%. They beat the market per se, but the market was down and they get bonus for you losing money. Does that sound like a good deal? Does that sound like a way towards retirement? I don't think so. I mean, come on, that's crazy. But that's what happens in our industry. So what happens is fund managers are guessing by throwing darts just as much as you could do it. And when you look at the fees that you pay fund managers over time, you'll see that it's about 2,000% more. In fact, in the studies, I'm going to show you this, and this is why I never used managed funds. First of all, $100,000 invested for 25 years. Think about that. You put $100,000 in the market for 25 years at a 6% interest, which is the average of the stock market over the last 100 years. What happens is you would earn about $430,000 in that investing strategy by letting it compound over 25 years. But here's the interesting thing. At 2% fees for the fund manager, you're going to be left with $260,000 of that $430,000. So they just took 40% of your money with a compounding 2% fee per year. So I want you to think that through, because If they have higher fees than that, you're wiping out upwards of 70% of your wealth by putting it in somebody else's hands. That's why, to me, financial literacy is so important, to take the time out to learn to manage your own money. And there's ways to do it. So I'm going to show you a strategy right now that actually Ray has put together. You're going to have to research it a little bit, but you can do this by only putting a little bit of energy in every year. And it's called the Holy Grail strategy, and it's a non-correlation strategy where what he does, I'm going to switch back over to my iPad so I can show this. Let me stop sharing here. And by the way, if you're enjoying this, just let me know, give me a yes, or let me know what your best thing you've learned so far is, the most powerful takeaway. I'd like you to share that with me. So I stopped sharing that. Let me go over here and share. Okay, I'm going to bring up the notepad again. I want to see if you can see that. Okay, if you can see the notepad, let me know. Just type in yes, I can see it. Okay, good. Wonderful. Okay, so let me show you the strategy that Dalio uses. In fact, can I show you a bonus strategy as well, so I can give you two strategies? Would that be okay? So I'll show you one that I'm using right now that's doing very well. And this was a very simple one that's very conservative, and it's made a lot of money. In fact, this is one that Warren Buffett says, do this and do this long term. It'll make you tremendous money. And that is basically the S&P 500 strategy, where you're just going to buy the S&P 500. And if you don't know what that is, those are the 500 largest stocks. It's like a big basket. It represents the US economy. So these are like a basket of the great stocks that represent America business, capitalism. So instead of buying or picking stocks, you just want to buy the basket of these stocks. And you want to hold on to these for the long term. So you want to find a fund that is very low cost, or you can do what I do, which is an ETF. An ETF is an exchange traded fund. It's like a managed fund, but you don't have a manager per se. You are investing with your own money through your brokerage account. So the one I use is called VOO. The ticker symbol is VOO, and that is the Vanguard S&P 500 Index Fund. Very low fees. You can get involved in this for a mere very, very, very low fees. So they're not eating you alive like the managed funds. And what happens is when you buy this, you just start putting money into this every month, every year, and you let it sit there. And that means it'll go through the ups and the downs as the market moves. Remember, the market never moves straight up. It moves up over time, and it has its crashes, and you keep investing along the way. So this is allowing you to compound. And this is a very safe way to compound your money because you're getting the best stocks in the industry. 96% of fund managers do not even match or beat this strategy. So why would you give them money to take money from you to do worse than you could do by just doing this? Does that make sense? So you invest in like a VOO, which is the ETF, or you can go to Vanguard and look at their lowest cost S&P 500 fund and invest in that and keep putting your money into it over time and allow that to grow. If you're younger and you have time on your side, this is an excellent strategy. This is something I wish I would have done in my 20s. Unfortunately, I was too busy being broke, watching TV and going to parties. That's what young people do. But if I would have really gotten involved in doing something like this, that would have made a huge game changer for me and my family early on. Over time, that would have really made a difference. So that's one strategy I want to share with you. The other one is the Holy Grail that Ray talks about. So what he did is he researched this, and this has been the best strategy, bar none, out of anything. So let me show you what he does. If you take your money and you create a portfolio, you're going to break it up into a piece of pie, and you want to basically have it in such a way where you have a percentage of it, 40% of it. You want 40% of this to be in bonds. Now, if you don't know what a bond is, I'm not going to have time to get into bonds, but bonds are a debt instrument, and they're backed by the government. So 40% would be in what we call long-term bonds, okay? Now, let me just ask, I'll just do a real quick quiz here to see what you know about bonds. If you know what a bond is, type in yes. If you understand how they work, type yes so I can see if you understand those. I'm going to switch over and see if you're, because I can't find where my chat is on here. Here, there it is. Okay. Yes, yes. Okay, good. Some people know. All right, so most people don't know what a bond is. In fact, when we do surveys, we find most people don't know what they are. So a bond is a debt instrument, and I'm going to come back and show you how that works in a real quick minute. But right now, just note this: 40% of your money goes into bonds, and then you're going to actually put in 30% of your money into stocks. Okay. Then 15% into another type of bond called intermediate. So intermediate bonds. Then you have the 7.5% of your money in gold and another 7.5% of your money in other commodities. Could be like coffee or cocoa or silver, different things like that. So there are other commodities. Okay, and this will get you 100% invested. So what you have is a non-correlated portfolio where no matter what happens in the markets, we know there's a crash coming because we have bubbles everywhere. But as things go down, other things go up. If you pick the right portfolio, you'll offset the risk. The power of this is the more positions you add to this portfolio, the more your risk goes down. And your factor of growth and return goes up by 5 times. And that's what's really powerful about this. It reduces risk with more investment as long as you're diversifying among these asset classes, and your potential returns go up. It's phenomenal. Now, it gets kind of deeper, but you want to research it. It's called the Holy Grail Strategy by Ray Dalio. It's the best performing strategy out there. It's been doing this since the 70s. Beautiful, beautiful strategy for those of you that want to do it. And by the way, you only have to manage this and reposition it once a year. Every year you want to rebalance your portfolio, and you can research this by just researching Ray Dalio. You can read his book called Principles, or even Tony Robbins interviewed Ray, and he has a segment in his book on money from Ray Dalio. I always use Google. You can always find that as well. So that is called the Holy Grail Strategy. If you set this up, potentially using the VOO strategy, you have 2 great strategies for long-term investing to create long-term growth in your portfolios. Is there any questions on that? Type in what you just learned there. If you learned something, type in what it was that you learned, that's your takeaway. I'm going to stop sharing the screen really quick. And we're going to go back to the slideshow. Okay, so that's the Holy Grail strategy. Great way to generate long-term growth in your portfolio. I don't see any questions coming in on that, so hopefully that made sense. Again, dig deep into that. If you want to research it more on exactly how to do it, just look it up, and that's a good one to just start with and work with. Now, I said I was going to share with you a little bit about bonds, so let me just share this with you about the bonds so you understand what bonds are. Now, most people don't get this. I want you to think of it like this. A bond is simply a debt instrument. So if somebody needs money, they need money, they can't get one person to loan them money because it's such a huge amount of money that not one entity or one person could do it. So think about a bond being like a big debt instrument that they cut up into little pieces, and they auction off those little pieces so people can actually invest in the debt and get a return. So let me just give an example here. Let's say Lola here, she wants to borrow $100 from me, okay? And so I'm willing to pay her $100, but the agreement on the bond would say that I'm willing to give you $100, but what's gonna happen is you have 5 years to pay me the $100 back At the end of the term, you're going to owe me that $100, but every year you're going to pay me 5%. So I'm essentially making 5% a year on that $100. At the end of the 5 years, I get the $100 back. That's how a bond works. Now, here's the interesting thing. If Lola, for example, is working well, and this is a good bond, but let's say she loses her career, her job, and she's not creditworthy. Something happens bad in her life. Now, the bond is not going to be valued the same. That $100 bond is not probably worth $100 because if I wanted to go to the auction and sell the bond, nobody's going to buy the bond for $100 because they look at Lola's creditworthiness in this case, and they would say, well, she doesn't have a job, she's struggling. I don't think she's going to be able to repay in 5 years. And what would happen is they're not going to offer you $100 for the bond. So what they'll do is they might offer you $90 for the bond. Well, if I'm selling the bond, I'll take the bond for $90. I get my $90 back. Now, whoever owns the bond, they're still getting 5% per year on the bond. But here's the question. Is it actually the same amount of return on that position? Yes or no? Type it in. And the answer is no. Because they're now not getting 5%. Essentially, what they're getting is like a 7% return on $90. So they paid $90. They're still getting 5% off the $100, which comes out to about 7% return on the bond, which means this is the inverse that you need to understand. As interest rates, right, as bonds fall, interest rates go up, right? So bonds go down in value, interest rates go up, and vice versa. If interest rates are going down, bond value is going up. So there's good bonds too. There's some bonds that people really are wanting in their portfolio. They're willing to pay more because they're very, very good bonds. And if I took that bond to market and said, Lola's doing amazing, she's on fire, everything's working, and they feel very good about the bond, they might want to pay $110 for the bond. Now, if I sell the bond for $110 and I get $110, the return on that bond now for the buyer is not 5%, it's more like 3%. So the interest rate has gone down, but the bond value has gone up. So that's the inverse that we see in the bond market. It's like a teeter-totter. Now, if you look at what's happened in our economy, the Federal Reserve wanting to drive interest rates lower, what did they have to do? Because they got interest rates so low in the economy, they were close to zero. So the only way for them to lower interest rates more is to do what? Type it in if you know. Think of what I just taught you there. They have to go out and buy bonds. Now, think about this. The Federal Reserve is buying bonds, and it takes money to buy bonds. Where do they get the money? They print it out of thin air because that's what they do. They're magic. They can print money out of thin air, create money like that, and then they take that money and they go and they buy bonds. And all that's happening in our government between the Federal Reserve bankers, which is a private corporation, and the Treasury and the banks around the world is a Ponzi scheme. And what they're doing is they're exchanging paper. It's very confusing for the public. And what we have is a bubble in the bond market. It is a huge bubble, which means it will collapse. And when it collapses, obviously as bonds are increasing in value, the interest rates are going where? Down. But when these bonds collapse, where are interest rates going to go? Up, right? And that is one of the biggest markets in the world, the bond market. And by the way, did they go up naturally, organically, or did they go up through artificial inflation? Which one do you think? A or B? Naturally A, artificial B. Which one do you think? Yep, absolutely B. B is artificial, so they manipulated the bond market and the currency supply. So what this has done globally is created major problems. In Europe, we have what we call negative interest rates. Now, think about this. Negative interest rates means that people are willing to loan you money and they'll pay you to loan you money. Does that make sense? I mean, if you're going to buy a car from a car dealership and the car dealership says you can buy it cash and you'll get the car, or if you buy it on credit, we'll actually pay you to use the credit. So you're not paying an interest rate on the car loan. They're paying you to take their loan. That's asinine, and that's happening in Europe. So these are signs that there's crumbling going on in the infrastructure of our global economy. It is a systemic risk. So understanding we have systemic risk, you've got to think to yourself, how do I protect myself about what's going to happen here? Because there is a bigger bubble coming, and it's bigger than we've seen in the past. And it's not just in real estate, it's in every market. The bond market, the real estate market, the stock market. And when is it going to crash? I don't know. But I know this, that you can prepare yourself so that you're positioning yourself properly. So when it does crash, you have cash ready to go to buy when there's blood in the streets. You might want to invest in gold and silver because that's tangible, real money. And I would never put that in a bank, never let a bank touch that unless you want it taken away from you. I would do a lot of things to prepare for what's coming because it's inevitable. It's a mathematical certainty that we are going to crash. And it's going to be much bigger than the 2008 credit crisis. So these are things I look at as I study because these are important things to know. I've been through two bubbles, the stock market and the real estate, and I will tell you, you get knocked out. But you start to learn through getting punched in the face. I think Mike Tyson said everybody has a plan until they get punched in the face. But you learn a lot when you get punched in the face. I've had many punches in my face. And I learned how to keep my hands up, actually. So that's really what happens. So the bond market is a big bubble, and it's impacting everything. So I wanted to share that with you as well. Let me go a little bit further here. And let me ask, so I just wanted to kind of cover what we covered tonight. We started off talking about money versus currency. Most people don't know the difference. What is the difference? If you remember, type it in. What is money and what is currency? Money is what? Money is tangible. Gold, silver, real value, tangible money. And it's constitutional. The Constitution was written that real money is gold, based on gold. The dollar used to be backed by the gold standard. It was taken off. And by the way, our dollar was then changed under Nixon to what we call the petrodollar. And the petrodollar means all that happened was Henry Kissinger went over to Saudi Arabia and said, you guys have a lot of oil. We have a lot of bombs. We're going to do a deal. We want you to make every country in the world buy oil through US dollars, which means they had to trade their currency into dollars. And then you sell them oil. And then what the Saudis would do is they would buy our treasury bonds. And that gave us a lot of money and a standard of living in America that's higher than most countries, in fact, all countries in the world. And the problem with that is it's artificial as well, because now that's being broken, the petrodollar. And the reason we go to a lot of wars is really about the oil. And what's happening is they're uncoupling the dollar oil trade, and they have other ways to buy oil now. And that will ruin America's standard of living, bringing us back down. So understand there's a lot of things going on in the global machine that most people are not literate in, and therefore there are a lot of risk. The way you get rid of risk is get more education. The more knowledge you have, the more you can comfortably take actions that you mitigate risk. And that's really what it's about. And that's on the external world. On the internal world, it's knowing who you are. When you know who you are and you operate from flow, knowing that you're the abundance, the real value is you, then what I would tell you is everything outside of you can be manipulated and controlled. Inside of you cannot be unless you let it. So the more skills you gain in yourself, the more knowledge. I always trade my money for more knowledge. I trade my money for mentors, for trainings, because the more I know, the more I survive no matter what happens externally. Does that make sense? A lot of people think the real value is out there. The real value is us. So what's been the most valuable for you tonight that you've learned? Type it in right now. What's the most valuable thing that you've learned tonight? The big takeaway. By the way, I want to thank you all. This is my first one, and hopefully it wasn't too fumbled across, but we're going to get these better. Learning how to use Zoom and all these little devices worked great yesterday. Tonight we had a lot of problems with the devices, but they're going to get better and better. I'm going to do one of these every month for the Authentic Elevation Room on different topics. So I appreciate you all being in here. And asset and liability was the big takeaway. Okay, so good. Understanding the difference between an asset which increases your value, and a liability which decreases your value, and knowing the difference between the two. Wonderful. Anything else? Now, some of the stuff, if you guys want to research this, definitely you can DM me and I'll share with you where you can go to research it so you have the facts and you can see how this is all put together. Here's what I want you to do if you're up for the challenge. These are prescriptions I want to give you, the little pills that you can take that will help you get some more insight on some of these areas. Number one, there's a great video that Mike Maloney put together. It's animated, so it makes it really easy to understand. If you go to YouTube and watch the Hidden Secrets of Money, episode 4, he teaches you in there how our debt is growing so much faster than our currency that what's going to happen is we're going to have a major bust in the economy. That is a valuable thing for you to know, because when you know that, you're able to take advantage of the discounting of what's going on in the economy when most people are not going to be ready for that. So I really want you to be educated and prepared, not saying I know when it's going to happen or how big it will be, but I'm saying this: why do we have insurance? Just in case. I mean, you might never wreck, you might think you're a great driver, but if you drive without insurance, it's kind of stupid. So I know I'm a good driver, I'm safe, but knock on wood, I won't have a wreck, but if I do, I have insurance. So the Hidden Secrets of Money will teach you what's going on in a very simple way where most people don't understand it, and you'll understand how they're manipulating the entire money system and how through physics it's going to have to fall soon. So go watch that tonight if you can. It's about 20 minutes is all I think on that video. Number two, if you've not read the book by Robert Kiyosaki, this was one of my first books, Rich Dad, Poor Dad. Go read it. It's very simple. Don't read it once, read it 10 times, and ingrain it in your head so you start to look at the world through assets, liabilities. You start to ask the right questions and get the wrong questions out of your life, and it will change the entire dynamics of your portfolio. It'll change your real estate, your stock market investing. It'll change your money and your debt and assets, your liabilities and your assets. And those would be the big takeaways and the assignments that I have for you. So I want to thank you again for joining us tonight. We went just a little bit over an hour, but I appreciate you taking time out of your life. I'm going to record this. I'm going to post it on the wall in the Authentic Elevation group, or at least link to it if it doesn't post on the wall. And you can watch it again. And again, we'll be putting these up once a month. I'll be doing them live and sharing with you on different topics. Tonight, people want to learn about financial literacy, and hopefully you got some great tips out of it. So I want to thank you all, and otherwise have a beautiful, beautiful evening, and I'm going to go get some Italian food. Thanks for stopping by, guys. Have a great evening.